Welcome. I'm David Brown, Director of Executive Education at Imperial College Business School, and delighted to introduce you to the latest Imperial Future Matters series. Imperial is an interesting and unique university. Emerging from the Great Exhibition of 1851, our mission is to achieve excellence in research and education in science, engineering, medicine, and business for the benefit of society. For Imperial, a core part of this is enabling collaboration across disciplines. Charlie Donovan's Centre for Climate Finance and Investment is a terrific example of that interdisciplinary work. Another is Imperial's response to COVID that has required joined up thinking and groundbreaking contributions from across the whole college. We've also recently updated and launched an academic strategy that further drives interdisciplinary thinking and practice and enables increased focus on the world's most pressing challenges and opportunities with sustainability broadly defined at its core. Helping companies and individuals apply insights from across disciplines and industries is a huge part of our work. And in executive education, we are working with companies from across the world, both online and face-to-face. Our research and education means working with leading thinkers in industry, of which we have several today. Oops. So, thank you to the many speakers, several speakers. We'll have times for questions at the end, so please send them through in the Q&A. I'd first like to introduce our first two speakers. Charlie Donovan, who has been key to advancing the climate finance discussion. Charlie is Executive Director for the Centre for Climate Finance and Investment and Academic Director for the MSc in Climate Change, Management and Finance here at Imperial College Business School. Prior to his academic career, he was most recently Head of Structuring and Valuation at Global Power at BP and part of the team that launched BP's Alternative Energy Division in 2005 with a modest $8 billion funding commitment. But presenting first, I'd like to introduce Mike Waldron. Mike is Senior Energy Investment Analyst at the International Energy Agency. He's head of the investment team and project leader of the World's Energy Investment Report and was previously lead of the IEA's medium-term renewable energy market report. Prior to joining the IEA, Mike worked in investment banking in New York and London. Mike, thank you very much for joining. Over to you.
Okay, thank you very much, David. And I'm going to just get my presentation up here. Okay, I hope that all worked seamlessly. If you don't see the slides, then please give a shout. I just want to thank you for the opportunity to present our World Energy Investment Report, which was published at the end of May, and also for the collaboration with the Center on Climate Finance on Imperial. Just for those who are not familiar with the International Energy Agency, we advise governments around the world on policies and measures to help ensure energy security as well as to meet long-term sustainability goals. So in this relationship with the Imperial College Business School, I think we serve as a very interesting interface with the governments who are shaping the policies that determine how investments and finance flows into clean energy. So one of the ways that we do that is with various analytical products. The analytical product I'm going to present today is our World Energy Investment Report, which tracks investment, capital expenditure, but also looks at financing flows across the energy sector. And this is the 5th edition of the report. Normally, we're looking backwards. So normally we would look back at 2019. But this year, because of the COVID-19 pandemic, we're focused very much on what we see as the evolving trends in 2020, taking into account the latest available data we have through the middle of May. So with that, I'll get into the main results of the report. And again, I'm trying to take a bit of a tack here, which focuses on some of the finance-related findings, which will sort of shape the discussion we have today. But what we do is we track capital expenditures by all the companies, governments, consumers around the world across the energy sector. And when at the beginning of 2020, we were looking at plans for capital spending, we saw a modest increase of about 2%. This doesn't appear to be much, but considering that energy-related investments had declined every year since 2014, it actually represented a quite positive break-in trend. That said, with the COVID-19 pandemic, we've seen a 2% decline turn into an expectation of investments declining by 1/5 this year. These declines are particularly concentrated in regions where the oil and gas industry plays a big role. So the United States, Middle East and North Africa, Russia and the Caspian. But of course, investments are occurring in all countries, and all investment declines are occurring in all countries and all regions of the world, in line with what's going on in the macroeconomy. But there's some interesting sectoral dynamics that I'll describe in the next few slides. When we're looking at the reasons for energy companies cutting capital expenditures, one of those is due to kind of the practical disruptions associated with the pandemic. So this is the disruption of supply chains, delays to projects, sometimes deferrals, challenges in terms of equipment and labor. So these all sort of factor into the investment cuts. But a lot of it is due to the changing economic system for energy companies. This is particularly true in oil and gas. Oil is essentially the sector where the revenues that consumers pay are the largest, or the revenues, the global spending on energy by end users is about 90% devoted to oil and electricity. But oil is more dominant in terms of being a revenue producing industry. Now, what we see in 2020 is an expectations of a sharp change in this revenue picture. So oil companies are expected to get about $1 trillion less in revenues this year as a result of changing prices, changing demand picture. This also factors into revised expectations for how prices and demand will evolve in the years ahead. Whereas the electricity sector over time is relatively more stable in terms of its revenues, but exceptionally in 2020, we also see a dip here with perhaps a bit of a downward risk, as we've seen some delays or measures being taken to accommodate consumers and letting them have more time to pay their electricity bills, or potential defaults in their electricity bills as well. Now, this economic picture, when you combine the economic and the practical picture, how does it feed through in terms of investments in 2020? Clearly, the largest declines occur in the oil and gas sector. We see essentially all oil and gas companies cutting investments to some degree, while this year, or while 5 years ago, during the last oil price downturn, there was substantial room for cost cutting. This cost cutting scope has been much reduced. So the reduced expenditures are falling more into reduced activity than they are in terms of reducing costs. Other sectors also see investment declines, and I'll focus a bit more on the power sector in particular in the subsequent slides. But we also see investment declining in energy efficiency, which is related to spending on automobiles, construction activity, industrial activity, and also in other fuel supply sectors such as coal supply. Now, the power sector, where we don't see investment declines as much as in the fuel supply sector or in oil and gas, declines only about 10%. But the power sector is really at the heart of many strategies around the world for decarbonization, as well as economic development when you're looking at emerging economies and developing economies. So in that way, it's very strategically important. It's also worth putting the power sector declines into perspective of what we've seen during the past 5 years. So power investments really weren't growing. They were either stable or declining in some cases. A lot of this is due to the reduced role of coal power. So investments in coal power had gone down, investments in renewables have been somewhat stronger over the past 5 years. So it reflects this sort of broader decarbonization movement in the power sector. That said, what we expect in 2020 is a decline in solar PV and wind, while other renewables hold up a bit better. We also expect a decline in electricity grids, and this is the backbone and an important enabler for clean energy transitions. And when you look at these elements together, they're not going in the right direction. So investments need to be rising in these categories to pursue decarbonization aims rather than falling. Now, one of the indicators we track in terms of decarbonization of the power sector is looking at this trend in final investment decisions for coal plants. And I've mentioned before that these were declining over the years. What we've seen in 2020 is a bit of an uptick in terms of approvals being made by governments, but also decisions by companies to move forward with coal-fired power plants. And for us, this raises a bit of a warning as to the potential expansion of the coal fleet in the years ahead. Most of this is occurring in Asia, where you have new plants still being added to the system. There's of course a lot of retirements going on, but many of these retirements are occurring in places like the United States and Europe. So a bit of a mismatch as to where these are occurring. When we're looking at the overall trend in investment in clean energy, and of course, clean electricity plays an important role in this, renewable power, but also nuclear power. We've added battery storage as an important enabling technology, but clean energy is more than just power. It's also looking at direct applications or direct use of renewables for transport, such as liquid biofuels, or for heating applications. It's the entire world of energy efficiency, so investments to reduce the amount of energy that we're using, and also in other technologies which are related to the fossil fuel industry, but are important for decarbonization, such as carbon capture, utilization, and storage. What we see in 2020 is that the spending on all these technologies is likely to decline, but the share has actually increased. Last year, we were concerned that the share had been stuck around 1/3 of total energy investments, and it needed to go to 2/3 in the next decade. Well, the good news is that it's expected to go up in 2020, but not necessarily for the right reasons. It's going up because of the weakness in fossil fuel spending, whereas the overall spending in clean energy, though it's more resilient than fossil fuels, it's still not enough to meet long-term decarbonization goals, which under the IEA Sustainable Development Scenario would require a more than doubling of investment over the next decade. So how would the world attract these types of investments, or kind of what are the pathways out of the current crisis? We've looked at this in particular from a financing point of view, and of course the slides that Charlie will show will expand on this and elaborate in particular in the role of public markets. But we've looked at a few different actors and ways that the energy system is financed. This slide here focuses on the role of state-owned enterprises. So it gives you the ownership of the new investments, whether these are done by state-backed entities such as national oil companies or state-owned utilities, or whether they're done by private actors, with many of these private actors being motivated by policies at the same time. One important message that you see from this is it's no surprise that state-owned actors play much of a larger role in emerging economies than they do in advanced economies, but they also play much of a larger role in underpinning investments in fossil fuels compared to renewables, where in general we see clean energy investment much more driven by the private sector, but being influenced by those government policies. The infrastructure in the middle, the electricity networks, this actually presents another interesting finding that enabling a lot of the clean energy investments is having a robust grid, having a robust backbone. And in advanced economies, there is a role for state-owned enterprises, but in emerging economies, the SOEs play an overwhelming role in influencing investments. So investments in the energy sector and in clean energy transition, of course, depend a lot on financial investors, but they also depend a lot on the strategies and decisions of what governments and state-owned actors are doing as well. A couple ways, and the last two substantive slides I'll show, we did a bit of a deep dive on the role of institutional investors in energy and also sustainable finance. This also dovetails with what Charlie will show, but a few ways we looked at how institutional investors are participating in energy investments. And here it shows you their activity in refinancing and acquisitions, which from the standpoint of actual project investments, we see this as being currently as the largest route. And the interesting implication here is that refinancings and acquisitions have grown over time. In general, the role of institutional investors has grown as the larger sort of universe of transactions has grown, and there's been a greater amount of transactions in renewables in particular, with investors attracted by the perceived reliable cash flows of renewables, though this also applies to infrastructure as well. Where we don't see a lot of activity, or where we haven't seen a lot of growth, is in expanding this practice into emerging economies. Most of the deals that we've seen have been done in Europe and the United States, and most of the benefits to reducing the cost of capital have accrued there. And my last slide, I'll just touch upon a kind of last trend that we're tracking in terms of the role of investors in energy transition. And this is looking at the sustainable finance markets, specifically sustainable debt. So these would be investments, not just in projects, but also in companies and in pooled investment vehicles, like asset-backed securities or mortgage-backed securities. This is data that a number of different organizations also track as well. The interesting thing here is the diversification of sustainable finance instruments we've seen over the past few years amid rapid growth. So green bonds have been very important, but we've also seen sort of different shades of gray in terms of the advance of sustainability-linked debt, which is more linked to the performance of companies or projects rather than to their use of proceeds. By and large, most of these instruments, as it shows on the right, are going to support investments in renewables and energy efficiency and end use. But at the same time, as much as the instruments have grown in terms of financial flows, we haven't seen, as you saw before, the same type of growth in the capital expenditures. So these instruments are playing a really important role in terms of refinancing, reducing the cost of capital, improving funding options, but they haven't necessarily translated into an overall larger pie for renewables and efficiency, which perhaps could be something we discussed in the panel. So with that, I'll just leave my conclusions up here. I won't read them as they very much just echo the messages I gave during the presentation. And perhaps I will just turn it directly over to either David or Charlie for the next presentation.
Great, thank you, Mike. And a masterful overview as always. My name is Charlie Donovan, and thank you, David, for the kind introduction at the start. You know, after seeing that information, I could expect a number of people watching this might have the question, is anybody making any money at doing any of this? And we are certainly seeing a lot of shifts in terms of which technologies, where money's being allocated. But that key question about whether anybody is actually getting returns out of capital into this sector is the key question that we took into this report with the IEA. And what I want to talk to you about now over these next 10 minutes. So in terms of my agenda, there's three things I want to speak to. First, it's about closing off this technology trend and provide a snapshot into where we are on that in terms of renewable power. The second is to give you some highlights from this report that we did with the IEA, looking at returns in listed markets for fossil fuels versus renewable power. And then third is to just touch upon a couple of policy issues that are coming up and are going to be really prominent as we go into this fall, certainly with the US presidential election, and will have the potential to really accelerate the trends that Mike was talking about. So with that, let me share my screen and maybe give everybody a chance to stretch their backs a little bit. There's a lot of Zoom meetings these days, and always good to have a chance to move around. So while I just put this up, great, okay, and we're ready to go. So the first thing I want to speak to is about technology. And I think for those of us that have worked in this space, it is an astounding situation that we're in. And it is no overstatement to say that we are in the midst of a clean tech miracle, in particular on solar power. So if you look at this chart and the numbers circled there in gray, there were forecasts made a while back by the IEA, but by others who were trying to just be as aggressive and farsighted as they possibly could. And where we actually are on technology costs in terms of the cost of producing solar power as of today is at least 10 to 15 years ahead of schedule. And that has been due to an absolute revolutionary set of changes over the past decade in terms of the manufacturing costs of solar PV, economies of scale, but also improvements, incremental as well as radical innovations in the manufacturing process. And so, whereas we thought we would be having a conversation in 2020 about solar beginning to approach cost parity with fossil fuel power, we've blown right through it. And actually, if there's any problem in the market today, it's that solar power is so cheap and becoming so available that it's really upending pricing in conventional wholesale power markets. And that poses some challenges to the investment story going forward. But first, let me talk to you about what we found in this report. So we set out to try to understand what has been the experience over the past 10 years in listed equity markets for renewable power companies versus fossil fuel companies. And the report, which I really would encourage folks to go ahead and download from our website, has a full kind of set of results, and I just want to share a couple with you here. What I've circled in red on this slide, this summary slide, is a 5-year view of the performance of US renewable power portfolio versus the US fossil fuel portfolio. And you can see, I'll give you the numbers here. It was over the 5 years, a 66% total return for the renewable power portfolio and a negative 10% return for the fossil fuel portfolio. The numbers are similar for the 10-year view. And overall, what we found is that each and every time we constructed a portfolio from scratch, trying to have a pure play as possible on renewable power and fossil fuels, that the renewable power portfolios did better in terms of total return and did so with similar or lower levels of risk. And for those of us that work in finance, that's like the most basic recipe for success. And so I'll get into a couple of things that beg some questions about why we're actually not seeing more capital flow through the public markets, given this basic relationship. Before I do, I just want to touch upon one other aspect that we looked at, which was not just a 10-year and a 5-year historical period, but obviously we're living in a very different world today than we have in the past. And so the question we asked is, well, how has renewable power held up over the first 4 months of this year? A very interesting conclusion is that not only was renewable power doing well in the good years, but it did quite well in the bad times that at the start of this year as well. So renewable power exhibiting some defensive properties, not falling as far as the fossil fuel portfolio, which is the light blue line, and also recovering to be at the end of April, already back to where it was at the beginning of the year. Now, on this next slide, there is a point of curiosity. And the point of curiosity is you really have to squint your eyes here to see these little green stacks on each one of these quarterly figures. This is analysis that's been pulled together every year by Bloomberg. And what it's showing here is that the amount of investment that's flowing through public markets, that is on exchange, into clean energy, is a very, very small portion of total investment flows. And the question, given if the historical relationship has been one of higher performance and lower risk, why is the universe not expanding? Why are we not seeing more money flowing in? And one of the answers to that question is what we found when we built these portfolios, that, for example, for the US portfolio of renewable power, once we applied some basic filters to weed out the very, very small companies, we were left with just 18 companies that fulfilled this criteria that we had set forward. Now, on the fossil fuel side, we had 163 companies, so almost an order of magnitude larger. And so what it tells us is that there are still not enough names out there in the listed universe that would give investors a clean exposure to this sector. Now, as I begin to wrap up, what I want to talk about is where we go next. What do we need to do, both as academics and in the industry, to begin to understand the fundamental factors which are driving investment returns and start to forecast those into the future? Because the history is one part of it. And as we build sort of tools around strategic asset allocation, clearly those will come into play. But we are looking forward as well. And clearly there is going to be some serious change over the coming decade. And being able to anticipate that is as important as being able to accurately describe what's happened over the past. So for those of you that work in finance, a lot of this will be familiar, but we're beginning in this next report that we'll do with the IEA that will come out in the fall to look at a broader universe that'll be on a global basis. And with that bigger sample, we can really start to dig in and get to grips with what are the factors that constitute return. Now, there are a number of them that will be quite common. These are the style factors around value, size, things that are in the standard toolbox. But we also know at the outset that there are other macro factors that are probably going to come into play. We know that renewables are highly sensitive to interest rates. We know that the energy sector overall is sensitive to growth, not just headline economic growth, but also growth in energy consumption. And we know that inflation has some role to play. And there's a third bucket of factors that we're also quite interested to dig into, which are very specific to the sector and shaping returns. So market regime might describe the business models, the policies that are very specific to some countries. And one topic that I just want to highlight here is about carbon pricing. So we have some colleagues at Imperial that have been looking very seriously at this question: do investors care about carbon risk? And just like we have, the first thing that they would do is let's look backwards and see if we can detect a priced risk factor, which is around carbon from the historical returns in stock markets around the world. And their result so far is that absolutely, you can see not just in the energy sector, but in all sectors, a form of carbon risk premia that is not only persistent, but quite substantial in its size. So we have a short amount of time. I hope we can come back to some of these things in the Q&A, but I just want to summarize with 3 points. The first one is that technology is not the bottleneck towards decarbonizing the energy system. There are certainly other industrial sectors outside of power and transport for which we still have a lot of work to do on the scientific end. But in broadest scale, we have what we need to decarbonize fully the power sector and do a lot in the transportation sector. And so don't let anyone fool you and think that it's the scientists that have the job to do. It's really those of us that work in financial markets who need to step up to the plate now. Most importantly there is that capital markets are going to need to evolve. They will need to evolve both to expand the universe of investments available in the listed space, but also bring greater transparency towards the unlisted market where a lot of the action is happening today. And finally, what we do on policy today is really going to lock us into the future that we see over the next decades. And that is a statement that has been made by a number of people, but I think it's important that we keep in mind that the long lead times on building new infrastructure mean that the challenges of 2050 are really the investment decision challenges of today. And so with that, I'd like to turn it over to a few colleagues who we've invited to join us to share their perspectives on some of the challenges that we are describing here. So I'll just introduce each of the, say a bit about each of them at the start, and then we'll start in turn with 5 minutes of we've asked them to provide some perspectives, and that should leave us a healthy amount of time at the end for Q&A. And hopefully you will see that there is a chat box there that we've invited people to go ahead and put questions in, and I'll hand it back to David at the end to moderate that. So we have 3 great guests here. Zoe Knight is a managing director and global head of the HSBC Center for Sustainable Finance. She's been with the bank for many years and actually founded this center that we've had a great pleasure to do a number of pieces of work with. Deidre Cooper is portfolio manager at 91, a rebranded Investec Asset Management. Also very proud to say that she is an advisory board member for the Center of Climate Finance and Investment at Imperial College Business School. And finally, Robert Scharf, who's the CEO and has been there for about a decade now at the Luxembourg Stock Exchange and has a long background in corporate banking. So you have 3 individuals, each coming from different perspectives here that we hope can enliven and enrichen this debate. So with that, Zoe, I'm going to hand it over to you, and you can go ahead and turn on your video, and I'll go ahead and mute myself.
Thanks, Charlie. And I'm so delighted to be here with you all today. And you're right, it's 10 years this month since I've been at HSBC. And in the last 2 years, since we've launched the Centre of Sustainable Finance, we've published about 60 reports across how to decarbonise the real economy and also how to mobilise financial flows in order to address some of these challenges. So I'm going to cover 3 points in response to Michael and Charlie this morning. 1, about performance. 2, about renewable energy as being a solution, and we can't underplay the demand for renewable energy from industry as well as power and transport. And then the third point about the post-COVID landscape. So first off, in terms of performance, it's critically important that people carry on doing these studies around risk and return, because there is an ongoing conversation in the sustainable finance market and ESG more broadly about outperformance. And clearly it depends on which time frame you're looking at or which asset class you're looking at, but it's critical that we keep pushing those areas about the performance of integrating ESG and sustainable finance. But crucially, in terms of renewable energy, there are other signals for investors in terms of the future catalyst of price performance, in terms of increasing demand for renewables. And some of those come from initiatives like RE100, climate action groups, because they demonstrate that those companies will be increasing their demand for renewable power and therefore can potentially invest directly in those systems. One of the points that came out of the previous discussion was that much of the capacity going forward will be unlisted. Indeed, a study from McKinsey said that 70% of renewable capacity will be unlisted over the next 10 years. So we really need financing more broadly, not just investment, to help mobilize capital expenditure from companies themselves. And that brings me on to the second point about the power of industry in terms of scaling up capacity. We do a lot of work with the Energy Transition Commission, which was focused on hard to abate sectors and what steel, mining, chemicals, etc. might do to create decarbonisation roadmaps. And one of these areas is about looking at green hydrogen. And the Commission estimate that there needs to be a 4 to 5 times increase in renewable capacity for that transition to green hydrogen. So the role of industry in terms of stimulating demand, and therefore the capital that comes from industry, is a really useful area to look at in terms of where the demand drivers might be. That brings me on to another point around policy, which I'm sure that we will pick up later on in the conversation. One of the barriers around renewable energy scale-up can be the role of the state and the fact that the state power provider might be a monopoly, and that the regulatory backdrop isn't in place for corporates to be able to source the renewable power that they need, or indeed invest in direct capacity. And that is slowing down the market. So particularly in emerging markets, one way to build back better after COVID is to help liberalise the energy sector in order to bring in either direct investment on a national basis or foreign direct investment from those corporates that are operating globally, that have made pledges to deliver 100% of their power needs from renewables, in order to attract the capital that the country needs, and in turn decarbonise and create different jobs as we exit COVID. Just another point in terms of the COVID landscape, we did a little bit of work as preparation for this call in terms of the internal rates of return required for renewables versus fossil fuels pre the COVID crisis. And indeed, renewables were delivering around 5 to 10% IRR during that time, which, given the low interest rate environment, is clearly worth looking back for investors. But they were only marginally competitive with fossil fuels at $60 a barrel. Now, of course, with the changing oil price dynamic, we're seeing a lot more competitiveness through renewables, which means that there's a lot more to play for as we exit the crisis. I'm going to stop there and hand over to Deirdre, who's going to talk through her perspectives on this paper.
Thank you so much, Zoe, and thank you, Charlie and Michael, for what I think is a really interesting and important piece of work. You know, I think if I think about my own experience over the last 2 years or so, where I've spent an enormous amount of time traveling and now virtually, which is so much better, around the world, talking to asset owners, asset allocators about this sector. And I think your presentation helps to debunk what I think are probably the three biggest myths that need to be overcome in order, to solve this huge climate crisis that we have ahead of us. And many of this, echo some of the points that Zoe made. The first one, as Zoe said, is that there is still this misperception that returns and sustainability sit on two different axes. So I still get, from well-respected research houses, a matrix that says this is what you have to do on the ESG front, and this is the return front. And those are two different opposing frameworks. And they typically put sort of philanthropy on one end of the spectrum and investment on the other, and assume that sustainability is a journey to philanthropy. And I think what this report helps to prove, and what the general performance of the sector is increasingly helping to prove, is that sustainability is a strategy. It's not possible over the longer term to have a business that can survive over the long term without taking into account the pace of the energy transition. And the work that Charlie highlighted on carbon just helps to highlight that at a much broader level, as does at a more micro level, just watching the behavior of some of the oil companies. It was interesting to see Michael's charts, right? The CEOs of the big oil companies have massively reduced capex, but generally they've kept their investments in the pro-energy transition companies very constant, because of course they indeed see these as the part of the business that they need to invest in for the future, the part of the business that has long-term potential and isn't likely to be a stranded asset. And then the other big misperception that you still get, which is extraordinary given the data that Charlie presented, is that renewables are an expensive solution. We saw this through COVID. We all saw articles that said, now given that we have this unprecedented crisis, we can no longer afford to solve climate change. And what is actually true, of course, is that there is a huge amount of investment needed, but that investment will no longer, in most parts of the world, raise the system's cost. There was a great study, a couple of weeks ago from the University of Berkeley, together with Grid Edge, highlighting the fact that you could build a 90% renewable energy grid in the United States, and that would be cheaper than the existing system. And of course, there's a wrinkle to that, which is that if you take it to 95 or 100%, the costs start to go up exponentially, because we are still dealing with intermittent technologies and battery technology to back it up. So if we head up towards 100, we need to oversize that system effectively to deal with the 2 weeks in January where there's no sun and no rain, or no wind. So do be careful of people who tell you 100% renewables is 10 times more expensive. It might be, but 90% renewables will be cheaper. And that gets you to the last myth, which is that renewables are a niche solution that can only address a very small piece of the pie, which is just really, given the cost dynamics, given the ability to integrate, given the battery storage element that Michael talked about, something that is just not true anymore. And then to think about Charlie's last question and to echo some of Zoe's comments, what can we do to accelerate this investment? And to some extent, I think the acceleration is happening, but it's not happening in any way quickly enough. And there I would definitely agree with Zoe that regulation, particularly on the renewable power side, is extremely important. And that's different to subsidies. So this sector no longer needs to be subsidized, as we talked about. This is, a technology that is the cheapest alternative in the vast majority of countries around the world. But there's a difference between policy and subsidy. And at a very basic level, what we're doing is taking what is in many parts of the world an electricity market that works on marginal cost. And introducing into that marginal cost market a technology that has zero marginal cost. So the thing about all of the renewables technologies is, of course, that the wind and the sun are free. And that means that you need significant change to market design, because as Michael highlighted, if the market is correctly designed, then those investments in renewable energy are extremely attractive investments, because they're very visible, they're They generate long-term cash flows in a low interest rate environment. That's a really interesting place to be. But that requires a market where you are no longer have the marginal, the marginal cost set per megawatt hour. It requires a change to the electricity market design. And this is something that I think will be really important in accelerating investment into renewable energy, in taking this, where we need to go over the course of the next 10 years. We start to see that happening. As Zoe said, large corporates providing contracts are helping address this in a very, exciting way, potentially moving much more quickly than the countries in which they sit. So announcements like that last December from Microsoft, who said they want to, reduce the carbon footprint of their entire supply chain by 50% over the next 10 years. The megawatt hours that go into all of those suppliers have to change. And that in some ways can catalyze investment just as much as any policy drivers. So I would leave it, with a kind of an optimistic message from our point of view, but still quite a lot to be done.
Thank you, Deirdre. That leaves me as the last speaker. In fact, thank you for providing me the opportunity of adding the perspective from an exchange world, not from any exchange, because the Luxembourg Stock Exchange is, as I tend to say, an exchange unlike any other, because we are less of a trading exchange and much more of a listing exchange. And the difference is, in fact, we are focused much more on bonds than on equity. And above all, we are linking basically issuers to the investors on an international basis. In a couple of words, in fact, the Luxembourg Stock Exchange is today, in fact, the biggest listing venue for bonds. But more importantly, in fact, we have created in 2016 what we call the Luxembourg Green Exchange, which is a platform dedicated entirely, in fact, to green financial instruments. And it all kicked off with green bonds. And I would limit, in fact, myself, in fact, to a couple of aspects coming from the market side and deriving from the fixed income market. So today, in fact, to give you just a couple of numbers, we are listing 370 green bonds for a counter value of roughly $300 billion US. We have a world market share of somewhere between 45 and 50%. And why are bonds important in this debate today? Well, first of all, because bonds are a very innovative tool to finance the energy transition. In fact, and there are numerous examples and projects that I could cite. And most of the green bonds, in fact, are focusing on renewable energy projects and energy efficiency projects. And to give you a perspective of what the market globally is doing, last year, in fact, was the best year ever, with $257 billion US of green bonds that were issued worldwide, and represented an increase of 50% versus the previous year. But still, huge success as such, but it's only a very small fraction of the securities market and of the debt market overall. So why is not more capital directed into this area is one of the questions. And the answer, a number of aspects have already been addressed by the previous speakers. Part of my answer would be it's a very young market. And it's an evolving market, but we are coming from very far, and we have a long way to go because we believe that this will be the future. And one of the elements that have been addressed by the previous speakers is the performance miss. I repeat it because it's an extremely important element that needs to be highlighted very clearly. It's not about the trade-off between securing a financial market conform return and making a positive social or environmental impact. And I think the report that was presented early on highlights this very clearly. There might be, in fact, structural barriers to investment. The one is obviously, in fact, and it has also been reported, it's the small universe or the insufficient universe of companies that you can invest in. But at the same time, energy projects are very capital intensive. And that's and where, in fact, many of these projects need to be financed through the capital markets or by loans. And this is where green bonds, in fact, play an extremely important role, because they allow companies, also renewable companies, renewable energy companies, to grow the number of projects which they have in the pipeline. And by the same way, in fact, increasing the balance sheet and ultimately the size of the company. So there is no miracle solution towards creating big companies that can be that are active in renewable energy and that can be invested by bigger institutional investors. And here, in fact, that's where I make the link between debt and equity, where they are acting in sync, because basically you need the two parts of it. Now, very often you hear complaints about depth and liquidity of these markets. I will not go into the detail of this, but ultimately, again, there's no miracle recipe. Companies need to grow over time. But if you are investing in less liquid companies, then in fact, you need another element which is extremely important. That means access to data. And I would say even, I would add, to better data, to structured, consistent data. And investors in that case, in fact, need the best disclosure and easiest access to investments and information overall. Now, to conclude and make my point, I think the green bond market has triggered a concrete shift of behavior of investors. And this shift of behavior is accelerating, because for the first time, in fact, investors were aware of where their money was going. What was it where the money was invested in? And this is a trend which is not going to go away. And I firmly believe that asset owners and also asset managers can drive part of the agenda for accelerating the development of the overall sector. Because if asset owners become more demanding about what they want to invest in, companies will have no other choice than respond to this. Otherwise, they will have problem of having access to sufficient capital. Therefore, renewable energy companies and projects is about investing into the future. And this is how we create value and drive change at the end. Thank you.
Great, thank you very much, Robert, and all panelists. A terrifically interesting set of presentations, which has stimulated a slew of questions. So let's get plunged right in there. But I would ask you to keep your responses reasonably brief, if I may. So let me start with David Manuel. If renewables are higher return and lower volatility, surely they'll support higher debt equity ratios. So there's less need for public markets, which was one of the areas. Perhaps Zoe, would you like to sort of comment on that? Just unmute. There we go.
Yeah. So interesting point. I think the key point is that the volume of investment required to scale up the renewable capacity to the degree that's necessary to solve emission reduction requires financing from both public and private, and therefore making the market scalable in different regions using different incentives and different drivers means that we've basically got to do everything at once. So you can't rely on one area of finance to be the saviour for the capacity scale up necessary, is the short answer.
Okay, all right, thank you. A question perhaps for you, Charlie, I think, but others may want to chime in. Is it possible that the lack of capital is a rational response because so much of the return is linked to policy? So total shareholder return has been actually linked to policy, and that the underlying economics are actually not that good.
I think, you know, I always say that I mean, the economics and profitability are kind of, you know, they're concepts that have really no meaning. It's always about the rate of profitability relative to some benchmark or to some hurdle rate. So I think there clearly, if there was one issue that's holding back, and you might say that the returns that are observed are not sufficient, is because there's a huge amount of uncertainty going forward. And that's probably where this policy issue starts to collapse and prevent progress, which is that if you have, you know, in a number of areas, and we've seen, you know, the Bank of England's talked a lot about this with regards to Brexit, which is that uncertainty has a demonstrable break on investment flows. And so the whole sector, actually, I would say energy sector as a whole has become more risky. If we look at, you know, the amount of capital that is going through, let's say, to energy companies on the S&P 500, we've less than 3% as of today of the S&P 500 is constituted of energy companies. A decade ago, that would have been in the low teens. So clearly, there is something that people may be saying, look, I just don't understand this. What the future looks like in this space, and in that sense, it absolutely could be a rational response.
Okay, thank you. Now, I'm not sure who this question's for, so please, you know, raise or get in there first, which is the very first question. How do you determine what counts as a clean energy investment and the problem of greenwashing?
Maybe I can kick it off, but it would also be good to hear the kind of the greenwashing angle from the investor perspective. I mean, at the IEA, when we're defining the universe of clean energy, and of course we have a couple reference publications here. One is our Tracking Clean Energy Progress Report, which came out about a month ago. I mean, it's tracking those technologies which are instrumental for energy transition. The technologies that I showed you on the slide there are primarily low carbon technologies. They also include key enabling technologies such as battery storage, but it's important to remember in the IEA sustainable development scenario, so looking ahead 10, 20 years, there's a range of solutions and technologies which are needed for decarbonization. Some of those are not clean per se, but they have to do with reducing emissions from high emitting industries, such as reduction of methane emissions in oil and gas. And so we see all those types of solutions as being instrumental to achieving long-term sustainability goals. So we don't make a sort of judgment as to whether we see those as greenwashing or not, but we look heavily at the numbers to see that they add up in terms of emissions reductions.
The answer from the exchange point of view would be to say the best remedy, in fact, is transparency. And transparency means, in fact, having easy access to data. When I look, in fact, for example, at the green bonds that we are listing on this green exchange, in fact, we are not judging ourselves of how green, in fact, a project or a bond is. But at the end of the day, we are asking, in fact, from the issuers, very clearly the reports from pre-issuance to post-issuance. Today, in fact, even we are getting into the mode of impact reports, and the investor needs to have access to a full set of meaningful data that allows him to make his own judgment.
Okay. Thank you.
Maybe if I can add to that, I think I would 100% agree with the transparency point. You know, we publish an impact report for the strategy that I manage. And I think when looking at impact reports, it's really important that they highlight the positive impacts, but also the negative externalities, because even, and I think there were some questions on this, you know, even some of the cleanest technologies obviously have a footprint in manufacturing them, have other ESG issues. There's issues around just transition. So for us, you know, the sustainability impact reporting really requires a spirit of what we call radical transparency. You need to highlight the good and the bad. We have disclosure on every company that we hold in the impact report, not cherry picking just a couple that are really positive. And I think regulators are focusing on this. You know, we have the taxonomy coming in the EU, which is going into place next year, which is explicitly designed to combat greenwashing and to classify activities as green and not green. And that, of course, comes to some extent with its own issues. I think in spirit, it's a love to hear Zoe's view, but it's an initiative we support because I think it is really important to have better reporting. If you go into all the detail, do we agree with every single line item? Probably not, but it is a, comply or explain. So you have the flexibility to say on these particular sectors, our view of what's low carbon might be slightly different. In the power sector, I think a next iteration we've certainly talked about with the team at Imperial, and is something that we do, is rather than classifying, a certain group on the extreme or clean and this or dirty, is rather to look at the owners across the world of power generation. So we have a database of all the power plants around the world, and then to calculate their footprint and compare that footprint to the grid in which they sit. So effectively to model what a carbon price would look like. And I think that's an interesting way of thinking about whether low carbon outperforms high carbon. And it's, it's certainly, we've seen over time that has been the case.
Thank you.
And just building on that, it was right, in terms of the taxonomy helps with providing a framework, a consistent framework that helps investors with the transparency point. And so, to a certain degree, we've already gotten through the low-hanging fruit on green bonds and being able to now have a fairly good picture of what can be classified within the use of proceeds element of green bonds. The next tricky point, and this is a really tricky point because it's where the majority of the energy system is going to have to move to, it's what you do about transition companies. I think one of the questions in here was about gas and renewables and the differentiation of investment that's going into the both. It's not only gas, it's also industrials. I think I mentioned this earlier, but the use of energy in steel, the use of oil in petrochemicals and for fertilizer, these questions are incredibly complex when you get to move on from power and start thinking about food systems as well. So the transition narrative can build upon the green narrative, and the green narrative has been incredibly powerful at creating that underlying comprehension of use of proceeds and transparency, which Deirdre referred to as necessary.
So the great news is that we've got dozens, if not hundreds of questions here, so we'll figure out afterwards what we do with those. I'll take a last one, if I may, which is, almost all of you have spoken about the lack of investment and B, this balance between state and private, and indeed between debt and equity. One of the questions here, which is, given that so much of the investment needs to be around grid, to connect these different types of new energy sources, is that most appropriately financed and run by government or by private sector? Feel free to chime in.
I can take a shot at that. We're in also, there's a couple of big meta themes that are, I think, interesting to observe. One is the shift that has been happening already from public markets to private markets, and that's probably typified by some of the trends that we've seen in this report. But there's also been a huge trend, which is governments getting out of the role of being primary investors. And so, the idea about how this job gets done is by the private sector. And I don't think that's been made clear enough, because when we talk about climate finance, it's still anchored in very much an idea that somehow governments could get this job done. And when you look at the numbers involved, there's absolutely no way. And in fact, the governments as direct investors would be a very small fraction of what gets done. So I think it's really important that we start to shift the mindset towards what do governments do in their role as regulators in creating and maintaining markets that shape this risk return proposition for investors. And there has been a very confused role, I think, between, thinking that somehow more state intervention, more state activism, more state direct investment is somehow the solution to these problems. That would even if every country in the world decided that was the route for them, we'd still would be way, way off. And so I think that we really need to get clear, at least in my mind, that the appropriate role of good government might be, we can debate a number of different ways in which that can happen, but we have to get very serious about delivery mechanisms within governments that are very focused on how regulation shapes the markets that of the future and ultimately then attracts capital, private sector capital into it, and really move this from a public to mostly a private sector debate.
Brilliant. So we're pretty much out of time here, and I was keen to share the next slide, but wonderfully through the joys of the webinar, we've had our tech challenge at the very last moment. So what I do, and we'll send out some information on this, which is a couple of things. Firstly, we have the next webinar coming up in I haven't got the date right in front of me right now for these reasons. So, but it will be Jonathan Haskell, who's Professor of Economics at Imperial College London and a member of the Monetary Policy Committee, who's going to be talking about the economy in post-COVID. That is going to be on the 23rd of July at 12 o'clock, which is terrific. That'll be fantastic. And I want to pick up on with the phrase of one of the panelists who said, let's build back better. That will be absolutely fascinating. In closing, I want to say a huge thank you to Charlie Donovan, Imperial, for organizing this, Zoe, HSBC, Deirdre was Investec, Michael at the IEA, and Robert from the Luxembourg Stock Exchange. So thank you so much. This is part of a Exec Ed and Imperial webinar series, and look forward to seeing you next time.